Welcome to vTalkInsight, Market Drivers Daily for February 19th, 2026. AI is still the backbone of this market. But today the story is how bubble fears, re-accelerating growth, and diverging central bank paths are colliding to reshuffle risk premia across assets. AI remains the dominant macro theme, but the focus is shifting again. Earlier this week, we highlighted the move from simple chip scarcity toward return on capital and business model risk. Now that debate is feeding directly into how equity, credit, and even rate markets price the entire AI ecosystem. On the infrastructure side, the commitment from major platforms is still extraordinary. Meta is planning to deploy millions of NVIDIA processors, including next-generation accelerators and new Gray CPUs, a pipeline that could translate into well over $16 billion of revenue for NVIDIA and deepen its dominance in AI hardware. NVIDIA is also pushing into data center CPUs and has taken a stake in Synopsys, reinforcing the sense that the hardware stack is consolidating around a few key players. Asian semiconductor leaders in Taiwan and South Korea are riding that wave, with AI-related exports and equity performance highlighting that leadership in this cycle is genuinely global, not just U.S.-centric. At the same time, warnings about a potential AI Capex bubble are getting louder. The build-out of data centers is drawing comparisons with the old telecom boom, with concerns that power capacity and in-demand may not keep up with today's capital plans. Raspberry Pi's share price surge of nearly 90% this week on AI agent enthusiasm, alongside meme-like trading patterns, underlines how easily speculative pockets can form around the narrative. Fed officials are also flagging stretch valuations, narrow gains concentrated in a handful of AI names, and rising risks in leverage strategies, suggesting that financial stability, not just inflation, is now part of the AI discussion. The more painful adjustment is in software. The S&P Software Index is down about 20% year-to-date, with high-profile names like Palo Alto under pressure, as investors question whether today's AI Capex surge will actually translate into proportional revenue and margin expansion. Ownership in the group is at multi-decade lows, while some infrastructure vendors, such as Microsoft and Snowflake, report robust growth yet trade at historically low cash flow multiples. At the same time, leading enterprise software firms continue to deliver double-digit revenue growth and strong margins, arguing that AI is enhancing their models rather than making them obsolete. That split is forcing a sharper distinction between feature-based challengers and incumbents whose moats rest on compliance, governance, and deep integration into customer workflows. Beneath the market noise, real economy adoption keeps broadening. Healthcare providers are using AI to scale cardiac monitoring without matching staff increases. Gaming companies are investing in headcount to exploit AI-enabled creativity. And middle market firms report efficiency gains while focusing on retraining rather than mass layoffs. Large platforms such as Walmart are combining AI with data-driven personalization and an omni-channel footprint to gain share across income brackets. Open-source models in regions like India, Europe, and Africa are enabling customized local deployments at lower cost, while cost-effective Chinese models are intensifying global competitive pressure. Macro spillovers from AI are becoming more visible. Fed officials increasingly link potential productivity gains to a higher equilibrium real rate, implying that even with moderating inflation, policy may stay tighter than past cycles. Options markets have started to price higher volatility in AI-exposed sectors, but some see room for further repricing as uncertainty around terminal values persists. Looking ahead, the next phase of the story may hinge on proof points. Whether AI Capex shows up in sustained revenue, backlog, and margin metrics, and how upcoming IPOs from large AI firms could absorb liquidity from other parts of the market. In short, AI is evolving from a broad theme into a series of very specific winners, losers, and macro linkages, setting the stage for today's discussion on growth acceleration. The second key storyline is the strength and breadth of the growth backdrop. Recent quarters of U.S. GDP have been running above 3.5% annualized, and projections for the next year sit around 3% with upside toward 4% in the first half as Capex and activity broaden beyond tech. Real wages for U.S. workers have reportedly risen by about $1,400 on average over the past year, meaning income growth is now outpacing living costs for many households and supporting consumption. Productivity is a critical part of this story. Estimates put U.S. productivity growth near 3%, with aggregate supply potentially expanding at around 5% annually. That combination underpins forecasts for GDP growth running above 4%, well ahead of recent consensus. A prominent economist now sees U.S. potential growth rising toward 4% by the end of the decade, driven by advances in AI, semiconductors, and automation, a view echoed in commentary that points to higher trend growth and a structurally higher neutral interest rate. Importantly, growth is no longer just a mega-cap tech story. A new economic and earnings cycle appears to be underway, with median Russell 3000 earnings showing double-digit year-on-year gains in sectors like consumer goods, financials, and industrials participating. Durable goods data point to resilient business investment. Core capital goods orders have been rising, industrial production and business equipment orders are firm, and housing starts are at a 5-month high, all consistent with a solid fourth-quarter GDP print. In Europe, economic sentiment is improving outside France and Germany, while long positions in European basic resources and oil equities have been rewarded since December as cyclical recovery signals and commodity demand support these sectors. On the demand side, the consumer picture is also robust. U.S. same-store retail sales grew over 7% year-on-year last week, and early February data suggests that momentum is holding. Booking Holdings has reported strong fourth-quarter results and expects first-quarter revenue growth of 14% to 16%, with room nights up mid-single digits and solid forward bookings, pointing to resilient leisure travel. Travel and leisure is building lifestyle brands aimed at millennials and Gen Z, while retailers are investing heavily in in-store experience and omni-channel capabilities, with Walmart often cited as a leader in integrating stores, logistics, and data. Investment is not confined to services. Federal funding for projects like the $16 billion Hudson River Rail Tunnel restart, alongside tax incentives for U.S. manufacturing, is drawing capital into sectors such as appliances, autos, textiles, and defense. Manufacturing employment is rising, particularly in southern U.S. states, even as a skills gap leaves hundreds of thousands of positions unfilled and projections for 2 million vacancies by 2033. Integration of data centers and automation is expected to accelerate this transformation, increasing demand for technical roles. Silver is another interesting data point. Its dual role as precious and industrial metal, a persistent structural supply deficit, and surging usage in AI data centers, advanced semiconductors, solar panels, and emerging battery technologies all suggest a higher price floor and a constructive long-term demand story. There are, of course, caveats to this upbeat growth narrative. Consumer sentiment surveys are only just starting to catch up with the improvement in real incomes, reminding us that perceptions can lag the data. The U.S. trade and current account deficits are expected to widen as domestic investment, especially in AI and advanced technologies, outpaces national savings, raising questions about external balances. And while AI-driven productivity is supporting output, labor markets face longer-term challenges, from a large manufacturing skills gap to potential disruption in service sectors such as the UK, where the dominance of services heightens vulnerability to automation. For now, though, the evidence points to a broadening and strengthening cycle, which feeds directly into how central banks think about the appropriate level of policy rates. The third storyline is the increasingly uneven central bank pivot. Headline inflation has fallen sharply in several economies, prompting louder calls for rate cuts, but the growth dynamics we have just discussed and the AI-driven productivity debate are complicating the response. In the UK, consumer price inflation is down to around 3%, its lowest since last March, while Canadian inflation has dropped to roughly 2.3%. Those prints are encouraging doves, even though inflation remains above traditional targets. The Bank of England is at the center of this shift. Softer wage inflation and labor market data have triggered a rally in gilts, with yields moving lower as markets price a substantial probability of a rate cut as early as March and almost fully by April. UK inflation is seen as broadly on track despite a slightly stronger than expected January reading, and the combination of disinflation and weaker wage pressures has helped push UK equities, including the FTSE 100, to fresh record highs on anticipation of a more dovish stance. At the political level, proposals to strip the bank of non-core mandates, such as net zero, and refocus it squarely on inflation signal that monetary frameworks themselves could be revisited in the next electoral cycle. In the Eurozone, the issue is less about near-term data and more about leadership and independence. Speculation is mounting that Christine Lagarde may step down before her term ends, potentially opening the door to a broader reshuffle of the executive board just as several national governments seek greater influence. Some of the names floated as possible successors lean more hawkish, which, if realized, could tilt expectations toward a tighter stance over time, even as growth lags the U.S. Concerns that political maneuvering might shape the appointment process are raising questions about ECB independence and could, if they intensify, feed into a higher risk premium for Eurozone assets. The Federal Reserve sits in a different place on the spectrum. Recent commentary has emphasized a cautious, data-dependent approach and a higher bar for rate cuts, with several officials stating that they need more convincing evidence of disinflation before easing. AI is a key part of their thinking. On one hand, faster productivity could be disinflationary. On the other, heavy AI-related Capex, competition for lending, and strong growth momentum may push the neutral real rate higher, limiting room for aggressive cuts. Diverging views among Fed officials on whether AI is ultimately inflationary are adding to Treasury market uncertainty and keeping short-term yields elevated. This policy divergence has important cross-market implications. Markets broadly expect a weaker U.S. dollar if the Fed turns more dovish, but with U.S. growth projected around 4% versus roughly 1% in the Eurozone by decade's end, there's a plausible path to renewed dollar strength, especially if U.S. rates stay relatively high. At the same time, central banks in the UK, Canada, and several emerging markets are signaling or delivering cuts as inflation moves toward 2 to 3%, supporting a constructive narrative for emerging market assets. However, persistent youth unemployment in some of these economies and rising questions about central bank independence, particularly in Europe, highlight that the pivot is not risk-free. Pulling it all together, AI-driven growth, strong domestic demand, and uneven monetary easing mean that global policy is moving away from the synchronized cycles of the past decade, creating a more complex backdrop for rate, currency, and equity positioning. To sum up, AI remains the core engine of this market, but the story is fragmenting into infrastructure leaders, software repricing, and rising bubble concerns. Growth data, from U.S. productivity and real wages to global investment and travel demand, point to a broadening cycle that supports earnings but also argues for a higher structural growth path. Central banks are responding unevenly. The Bank of England edges toward cuts, the ECB wrestles with leadership risk, and the Fed leans toward higher for longer as it weighs AI's impact on the neutral rate. For portfolios, that combination suggests a world where dispersion, policy divergence, and proof of AI monetization matter more than simple risk-on or risk-off labels. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.